Chapter 3. Go long or go short. In the stock market, we can make money when the market is going up or down. Going long means that we are buying shares and intend to sell that shares at a higher value in the future. Example, we buy 3 shares of Apple at $100 each. We wait and we sell these 3 shares for $110 each. So we profit $10 per share times 3 shares is $30 profit. Going short means making money from the devaluation of a stock. This can sound a little bit strange, but is possible and works the following way. Let's say you short Apple 3 stocks. The broker will lend you 3 stocks that are immediately sold at the market price. So 3 stocks times 100 is $300. But you will not keep this $300. The broker keep it. Then in the future, you're gonna need to buy 3 stocks and give the broker back these 3 stocks when you want to exit your position. So Apple stocks go down as you expected, and now the current value is $90. You close your position by buying 3 shares and you pay $270. So your profit gonna be 300 minus 270 is $30 profit. Dangers of going short. When you go long, the worst case scenario is losing 100% of your position if the price of the stock goes to 0. When you go short, there is no upside. So the price can double, triple, and the movement can happen really fast. You can lose a lot of money, much more than you expected. Even if you have a stop loss, sometimes the gaps can be massive up. You can even owe money to your broker. In some cases, lose more than 100%. So you need to keep this in mind when you are shorting. Especially stocks that have high volatility, like pharmaceutical companies, stuff like that.